Welcome to the deep dive. We're here to cut through the noise, get straight to what matters.
That's the plan.
Today, we're taking a journey right into the digital frontier of money. We're tackling a question that's fascinated, maybe puzzled a lot of us. How can strangers move money online without a bank? Without any middleman, no central authority watching everything.
It sounds almost impossible when you first hear it, doesn't it?
It really does. So our mission today in this deep dive is to unravel the core concepts of cryptocurrency. We'll mostly focus on Bitcoin, kind of the original blueprint.
Good place to start.
Yeah, and we want to do it in simple, relatable terms. We're aiming for you to get a real, solid understanding without getting totally bogged down in jargon.
Yeah.
Hopefully some real aha moments. This isn't just a quick summary. It's a proper deep dive into how digital trust actually works. We want you walking away feeling genuinely well-informed.
It's a fantastic topic. And, to really get why it's so revolutionary, it helps to look back a bit at the history of money itself. For, millennia, humans have been looking for better ways to represent and exchange value. Money, really, it isn't just stuff. It's like a language.
Language.
Yeah, language of value. It's this linguistic abstraction we use to communicate worth to each other. It lets us express value, build social connections, form complex groups. And this language, it's evolved dramatically over tens of thousands of years.
Right, from barter.
Exactly. Started with barter, which was super inefficient. If I've got apples, you've got shoes, but I don't need shoes. Dead end.
Yeah.
So we moved to the first abstractions, commodity money, things like shells, feathers, beads, later precious metals, gold, silver.
Things that lasted, were easy to carry around, sort of.
Right. Portable, durable, divisible, widely accepted. Then came paper money, basically a promise of value.
Yeah.
Made things even easier, safer than lugging metal.
And then plastic. Cards.
Yep, plastic money, credit, debit cards, digitizing payments, huge convenience jump. And now we're looking at something totally new, network money.
Network money, okay.
And what's really fascinating and what our sources really drive home is that Bitcoin specifically isn't just money for the internet. It's more like the internet of money.
The internet of money. That's quite a statement.
Think about it. The internet lets us send information anywhere, instantly, no permission needed, right?
Yeah.
Bitcoin aims to do that for value. Many experts see it as the sixth major innovation in money's history. Why? Because it's the first system that's totally decentralized. No single entity, no government, no company controls it.
That's a huge shift.
It's a paradigm shift, absolutely.
Yeah.
And, it's worth remembering, when Bitcoin first showed up, people were skeptical, really skeptical.
Oh, yeah, I remember the headlines.
Dismissed as just for pornographers, terrorists, drug dealers, gamblers.
Yeah.
But if you look back, those were the exact same things people said about the internet in the early days, word for word.
Wow, really?
Yep. And just like the internet, which billions now use for, food, healthcare, education, just talking to each other. Bitcoin's real potential for global finance, for personal control, it goes way beyond those initial fears, which mostly turned out to be unfounded, didn't they?
That's a great parallel, puts it in perspective.
Yeah.
And what makes this text so compelling, maybe why some call it a gift to the entire world, is this promise it holds out.
Right,
Okay?
it promises that.
Control. Control over your own finances that theoretically cannot be seized, frozen, or censored. Imagine your savings being truly yours, inaccessible to anyone else without your, cryptographic say-so.
That's a powerful idea. Historically, governments have frozen assets, banks have failed, funds have been confiscated.
Exactly. This tech tackles those weak spots head-on, puts the power back with the individual. That's an idea.
Worth understanding properly, especially now with everything being so digital and connected.
Agreed. Definitely worth digging into the how. Okay, let's unpack this then. To really get how this internet of money works, how it delivers on that promise of uncensorable control, we need to start with the absolute basics, the building blocks. Imagine running a shop, right? But you have no way to track who owes what, who paid for what. Chaos.
Total chaos. You'd need some kind of record book.
Exactly. A reliable list of everything financial that's happened.
And that record is basically what we call a ledger. Simple as that. In its most basic form, a ledger is just a comprehensive book or maybe a digital file that keeps track of all financial transactions. Think of it as the ultimate public record for every single money movement in a system.
Okay, a record book.
Yeah. To make it super clear, let's imagine a really simple made-up cryptocurrency. Call it Scrooge coin.
Scrooge coin, I like it.
Okay, in the Scrooge coin world, there's one guy in charge, Scrooge himself. He runs everything. He holds the master ledger. Totally centralized.
Huh.
Alice wants to pay Bob. She tells Scrooge. Scrooge writes it down. Now, if Alice tries to spend that same Scrooge coin twice, that's the double spending problem. Scrooge just checks his ledger, sees it's already gone, and says, nope.
Makes sense.
He keeps an append-only ledger. New transactions get added to the end. Old ones can never be changed. This works fine if Scrooge is honest, never messes up, and is always around.
Big ifs.
Huge ifs. What if he's crooked? Or his computer dies? Or he decides he just doesn't like Alice's transaction.
Right, the central point of failure.
Exactly. So Bitcoin takes this ledger idea and decentralizes it radically using something called a blockchain.
The famous blockchain.
That's the one. Instead of one Scrooge, you have this massive network of computers, we call them nodes, all keeping an identical copy of this public record. The blockchain is also append-only, but it's better described as a tamper-evident log.
Tamper-evident. How so?
Okay, imagine a chain of sealed documents, like notarized contracts maybe. Each block in the blockchain is like one of those documents, stuffed with validated transactions.
Okay.
Now here's the crucial part. Each block is linked to the one before it. Not just linked, but linked with a hash pointer.
A hash pointer. What's that?
It's not just a link, it's a cryptographic summary, like a unique digital fingerprint of the entire contents of the previous block, generated from every single bit of data in that block.
So the fingerprint depends on everything inside the block.
Everything. When a new block is made, it literally includes the previous block's unique fingerprint in its own structure. So if someone tries to change even a tiny detail, one number, one letter in an old block,
The fingerprint changes.
instantly, which breaks the chain. Because the next block was sealed using the original fingerprint, that seal becomes invalid. The integrity is built in because, as our sources say, each document certificate ensures the integrity of the contents of the previous document. This makes it incredibly hard, practically impossible, to secretly change past records. Everyone would notice immediately. To fake it, you'd have to recalculate every single fingerprint for every block after the change, faster than all the honest computers combined, which is unlikely, astronomically unlikely, computationally infeasible for a network like Bitcoin's.
Okay, that chain analogy makes sense. Like superglued links with a secret formula. Very secure. But how do we prove who is making these transactions? How do we know it's me spending my Bitcoin, not someone else? That's where keys come in, isn't it? Sounds like digital ID.
Precisely. You don't use a username and password like your bank. Instead, you get a pair of special cryptographic keys, a public key and a private key.
Public and private. Okay.
Think of it like a unique, super secure lock, and it's one secret key.
Okay.
Your public key is, well, public. Anyone can see it. It's like your publicly visible lock. People use it to verify things you've done. Your private key, though, that's your secret. Your key to that lock. Only you have it. You guard it with your life because it's what you use to create digital signatures. These signatures mathematically prove you authorized a transaction.
Like signing a check, but digitally and way more secure.
Exactly. Another way to think about it. Your public key is your actor or your identity on the Bitcoin stage. It represents you. But only with the matching secret private key can you actually speak for that identity sign message's authorized spending.
So no one can impersonate me without my private key.
Correct. Even if someone knows your public key, sees all your past signatures, they absolutely can't forge your signature on some message without that private key. These keys are big too. Private keys are typically 256 bits. Public keys often 512 or 257 bits.
256 bits. How big is that, really?
It's astronomically huge. A number so large is considered impossible to guess by brute force, even with all the computers on Earth working together. That size is the core of their security.
Okay, so the private key is my secret signature. The public key lets others check it. But how do I actually send money to someone? I don't send it to their giant public key string, do I? Sounds messy.
No, you're right. That would be cumbersome. In practice, we use something much more user-friendly. A Bitcoin address.
An address, like a mailing address.
Kind of. An address is basically a condensed, public-facing version of your public key. Technically, it's usually a hash of a public key. Think of it as your digital mailbox for getting crypto. Like an email address, but just for receiving money. Shorter, less prone to typing errors than the full public key.
Okay, makes sense.
And what's really revolutionary here is the decentralized identity these addresses represent. They are literally identities that someone made up out of thin air.
Made up.
Yeah, you can create a new one whenever you want, instantly. No asking permission from a bank or a government, just generate a new key pair and bam, fresh address.
So I can have lots of addresses.
As many as you want. It's a key part of Bitcoin's privacy features, this ability to generate new identities on demand.
Interesting. Is there a risk of making the same one as someone else?
Good question. There's an important nuance. Generating keys out of thin air gives you a probabilistic guarantee against duplicates, meaning the chances of two people randomly generating the exact same private key are so incredibly tiny they're practically zero.
Because the number of possibilities is so huge.
Exactly, that 256-bit number we talked about. But, and this is crucial, this only holds true only when keys are generated at random, using proper cryptographic methods. If you try to make one from, say, a simple password, it's not secure at all.
Right. So use the random generator. And what does an address look like?
A typical Bitcoin address might look something like 108-1ZP, 1EBP5, key GFE, GMPTFTL5, SLMB7DUF.
Yeah.
A string of letters and numbers.
Okay, so let me see if I've got this straight. A transaction starts with me using my secret private key to authorize it. That signature is checked by my public key. The money goes to someone else's public Bitcoin address. And the record of all this lands on that public tamper-evident ledger, the blockchain.
You've nailed it. That's the technological foundation.
And that's how you get this control over your finances that cannot be seized, frozen, or censored. It's built into the tech itself.
Precisely. These three parts, ledgers, keys, addresses, they establish ownership, authorize transfers securely, and guarantee the integrity and public visibility of every single value movement. It's a system built on math and code, not really on trusting an institution.
Okay, that brings us to a really interesting point, though, a potential knowledge gap for listeners. If these private keys are just really, really long random numbers, what stops someone, just by pure sheer accident, from generating the exact same private key as someone else already using the network?
The collision question. It's a great one and very common.
Yeah, I mean, it's all just numbers, right? What happens then?
It is just a number, yes, but the scale of that number is, well, it's hard to comprehend. Remember, 256 bits. That's 2 to the power of 256 possible keys.
Which is a lot.
A lot doesn't even begin to cover it. It's a number vastly larger than the estimated number of atoms in the observable universe.
Wow.
Let me try an analogy. Imagine 1 grain of sand. Now imagine 1 grain of sand for every atom in the universe. Okay. Now imagine a whole universe filled with those universes of sand grains. You're still not even close to the number of possible Bitcoin private keys.
That's mind-bogglingly big.
It is. The probability of 2 people independently generating the exact same random 256-bit number is so infinitesimally small, it's considered statistically zero for all practical purposes. You are vastly more likely to win the lottery multiple times in a row while being struck by lightning simultaneously.
Okay, point taken. It's practically impossible.
Practically impossible if, and this is the key condition, again, keys are generated using truly random cryptographically secure methods. If that condition holds, accidental collision just isn't a realistic concern.
So if it did happen, theoretically.
Theoretically, both people would control the same funds. But again, the odds make this a non-issue in practice. The security rests on that randomness and the sheer vastness of the key space.
That definitely puts impossibly small into perspective. Okay, our keys are safe. Now, this is where it gets really interesting, I think. We've got the building blocks, ledger, keys, addresses. Let's follow the money. Let's trace a crypto payment from start to finish. It's not just send, right? There's a whole process.
Absolutely. It's quite an intricate dance to ensure security and integrity.
So first up, the transaction itself. What's actually in it? It's not just an amount, is it?
No, it's a structured piece of data. It has inputs. These basically point back to previous transactions where you receive the coins you're now spending, like referencing the specific dollar bills you got earlier.
Okay, where the money came from.
Exactly. Then it has outputs. These say where the coins are going, the recipient's address, and the amount, obviously. But also, crucially, any change that needs to come back to you.
Change. Like getting coins back from a shop.
Precisely like that, but you have to specify it. And there's also metadata stuff like the transaction size, how many inputs and outputs it has, a unique ID hash for the transaction itself, and even something called a lock time field for more advanced things like delaying a transaction.
Tell me more about the change address thing. That sounds different from my bank account.
It's quite different. In Bitcoin, the rule is the entirety of a transaction output must be consumed by another transaction or none of it. Meaning, if you have an unspent output, think of it like a digital coin worth, say, 25 Bitcoins, and you only want to pay someone 17 Bitcoins.
What happens to the other 8?
They don't just automatically stay in your account. You have to explicitly create a new output within that same transaction to send those 8 Bitcoins back to a new address that you control.
Ah, so I send the payment out, and I send the change back to myself in the same move.
Exactly. Just like getting physical change, but you're digitally handing it back to yourself, usually to a fresh address for privacy. This system is flexible, though. Transactions can have multiple inputs, gathering funds from different places, and multiple outputs, paying several people at once and getting change back. Makes splitting and merging value easy.
And the whole thing is signed.
Absolutely. The entire transaction is digitally signed using your private key. That's the cryptographic proof that you and only you authorized this specific movement of funds. Undeniable.
Okay, so I build this transaction, sign it, then what? Where does it go?
Once you broadcast it to the network, it doesn't just magically appear on the permanent blockchain right away. First, it enters the mempool.
Mempool, memory pool.
Yep, memory pool. It's basically a public waiting area, a digital lobby full of unconfirmed transactions. Every computer, every node on the Bitcoin network keeps its own version of this mempool.
So like a public bulletin board. Hey, everyone, I want to send this money.
That's a great way to put it. Before it gets officially logged in the permanent registry, it hangs out here, waiting to be processed.
And how does it get picked from the waiting room? Is it first come, first served?
Not necessarily. This is where transaction fees come in. Miners, the ones who build the blocks, are economically incentivized. They generally prioritize transactions that offer higher fees.
Ah, so you can pay more to jump the queue?
Pretty much. If you want your transaction processed faster, you attach a higher fee. Nodes might even replace a pending transaction in their pool if they hear a conflicting transaction, which includes a higher fee.
Conflicting. Like someone trying to spend the same money twice, but offering a bigger fee the second time?
Potentially, yes, or just replacing their own transaction with a higher fee to speed it up. It's rational behavior for miners. They want to maximize their earnings. So fees create a market for block space.
Okay. So miners grab transactions from the mempool, likely prioritizing the high fee ones. Then what? They bundle them up.
Exactly. They gather a collection of these validated transactions from the mempool and package them into a block.
The next block in the chain.
Correct. And each block has a specific structure. It starts with a header. This header is packed with vital info, a hash pointer referencing the previous block, linking the chain, a timestamp when it was created, a nonce, we'll get to that in a sec, and a Merkle root.
Merkle root. Sounds complicated.
It's actually a very clever and efficient cryptographic summary of all the transactions inside that block. It uses a structure called a Merkle tree. It basically lets you prove a specific transaction is in the block very quickly without having to sift through every single one.
Efficient verification.
Highly efficient. After the header comes the list of the transactions themselves. You could picture it like that notary again. Gathers signed contracts, transactions, puts them in a sealed box, the block, and stamps the box with a unique code, the header, including the Merkle root and the link to the previous box.
Okay, the block is packaged, but how does it get officially added? You mentioned miners and a nonce. This is the mining part, right? The puzzle race.
This is absolutely the mining part, and it's maybe the most ingenious piece of the whole design. Miners compete in this global, ongoing puzzle race. They're all trying to find the solution that lets them add the next block to the chain.
What's the puzzle?
It's a hash puzzle. They need to find a special number called a nonce. It's just a random number used only once. They take this nonce, combine it with the hash of the previous block and the Merkle root of their new transaction bundle.
Sure.
And then they run this whole package through a specific cryptographic hash function. For Bitcoin, it's SHA-256, run twice.
And what are they looking for?
They're looking for a nonce that makes the final hashed result smaller than some target value. Basically, the resulting hash needs to start with a certain number of leading zeros.
Like trying to roll dice until you get, say, 5 zeros in a row.
Exactly like that. And because of how cryptographic hashes work, there's no shortcut. You can't predict the output. The only way to find that magic nonce is brute force, trial and error. You just try enough nonces one by one until you get lucky.
So it's pure guessing, but super fast.
Millions, billions of guesses per second. It requires immense computing power, which means it uses a lot of electricity. That's the proof of work.
Okay, so it's like a global lottery. Thousands of computers guessing numbers constantly.
That's a perfect analogy.
Yeah.
A decentralized lottery. And the first miner to find a nonce that produces a hash below the target value wins. They get to add their block to the chain.
And what do they win? Bragging rights.
More than that, they get the block reward. Originally, it was 50 Bitcoins per block, then it dropped to 25, then 12.5, and so on. It has roughly every 4 years the famous halving.
Plus the fees.
Plus, they collect all the transaction fees for the transactions they included in their winning block. This dual incentive, the reward and the fees, is what motivates miners to spend all that money on hardware and electricity to secure the network.
Keeps the system running.
Keeps it running and secure. And to make sure blocks are found at a steady pace, the difficulty of that puzzle, how many zeros you need at the start of the hash, automatically adjusts.
It gets harder if more miners join.
Exactly. It adjusts every 2016 blocks, which is about every 2 weeks, aiming to keep the average block time around every 10 minutes, no matter how much computing power is on the network. It's like a built-in thermostat.
Clever. A self-regulating economic system. So the miner finds the nonce, adds the block. Is my transaction final then? Instantly secure?
Not quite instantly. This is where confirmations become really important for building trust over time.
Confirmations, okay.
Once a block is added, your transaction inside it has one confirmation. When the next block gets added on top of that one, your transaction now has 2 confirmations, and so on.
So each new block buries it deeper.
Exactly. Each new block makes all the previous blocks exponentially harder to change. Why? Because if an attacker wanted to reverse your transaction, they'd have to re-mine not just the block it's in, but all the blocks built on top of it since then.
And they'd have to do it faster than everyone else.
Faster than the entire rest of the honest network combined.
Yeah.
Which becomes practically impossible very quickly. That's why the industry standard is often to wafer 6 blocks, which takes roughly an hour.
6 confirmations for good measure.
Right. After 6 confirmations, the probability of a successful double spend attack becomes infinitesimally small.
Yeah.
These attacks are considered infeasible if the majority of miners, weighted by hash power, are following the protocol. It's like letting concrete set layer by layer. The deeper it is, the more solid and unchangeable it becomes.
That makes perfect sense. Layers of security building up over time. But this raises a couple of big questions, thinking about the long-term and the core security. Another potential knowledge gap, maybe.
Okay, like what?
First, how do we actually know there are enough honest miners? What if, hypothetically, more than half the mining power, 51%, turn malicious? Could they just gang up and rewrite history? The whole 51% attack thing?
Ah, the dreaded 51% attack. It's the boogeyman of proof of work.
And second, that block reward keeps halving, right? Eventually it goes to practically zero. What's the long-term plan then? How do we keep miners paid to secure the network if the main reward disappears?
Both absolutely crucial questions. They go right to the heart of Bitcoin's resilience and its economic design. Let's tackle the 51% attack first. Is it theoretically possible for one entity or a group to control over half the network's hash power? Yes, theoretically.
But practically?
Practically. On a network as large and valuable as Bitcoin, it's extraordinarily expensive and, crucially, likely financially suicidal for the attacker.
Why suicidal?
Think about the cost. Acquiring and running that much specialized mining hardware, the electricity, it's billions of dollars. Now, if they did manage it, what could they do? They could stop new transactions from confirming. They could reverse their own recent transactions, allowing them to double spend their coins.
So they could cheat people they just paid.
Yes. But importantly, they cannot create new coins out of thin air. And they cannot steal coins directly from other people's addresses if they don't have the private keys. Their main goal would be double spending their own money.
Okay. So what's the suicidal part?
The moment such an attack became known, and it likely would be detected, quickly, trust in Bitcoin would evaporate. The price would plummet. The very asset the attacker spent billions to control and manipulate would become worthless, wiping out their massive investment.
Ah, the economic incentive works against them.
Exactly. The network could also fight back with software changes, like a fork, to invalidate the attacker's chain. So, while possible, in theory, the economic disincentive is massive. It's profoundly irrational. The security isn't just code, it's game theory. It's infeasible if the majority of miners are following the protocol, because it's in their financial best interest to keep the system honest and valuable.
Okay, that makes sense. What about the diminishing block reward? What happens when it's gone?
The system is designed for a gradual transition. As the block reward shrinks over decades, the idea is that transaction fees will become the primary incentive for miners.
So the small fees people pay to send transactions will add up?
That's the plan. As Bitcoin adoption hopefully grows and more people use the network, the total value of transaction fees collected in each block should rise enough to replace the diminishing block reward and keep miners profitable and incentivized to secure the network. The fixed supply of 21 million coins also creates scarcity, which could support the coin's value, making even smaller fees worthwhile in the future. It's designed to be a self-sustaining fee market in the long run.
Interesting. A transition from subsidy to pure transaction market. Okay, shifting gears a bit. We've got transactions confirmed on the blockchain, secured by miners. Where do I actually keep my cryptocurrency? It's not physical. What exactly is a wallet?
Excellent question. And yeah, it's a common point of confusion. A crypto wallet doesn't actually store your cryptocurrency like your physical wallet holds cash or your bank account holds dollars.
It doesn't. Then what does it do?
It securely holds your secret keys that control Bitcoins. Your private keys, the coins themselves, they only exist as records on the public blockchain. Your wallet is just the software or hardware interface that manages your keys and lets you sign transactions to access those records.
So the wallet is really a keychain manager.
That's a great way to think about it. A very secure keychain manager. Now, these wallets come in different types, mainly based on who holds those crucial private keys.
Okay.
You've got custodial wallets. Think of exchanges like Coinbase or Binance, where you leave your crypto. In this case, they hold your private keys for you.
Like a bank holding my money.
Exactly like a bank. It's convenient, username, password, done. You trust them to keep it safe and give it back when you ask, but there are big risks.
Gotcha.
Well, you're trusting them completely. That exposes you to hacks. Remember Bitfinex, huge exchange hack, 40% of the money reportedly stolen from user accounts.
Ouch. Yeah, I remember that.
You're also vulnerable to things like Ponzi schemes, think Bernie Madoff, but with crypto, or even government actions. If regulators compel the exchange, they might freeze your assets or hand over your data. Our sources are blunt. Bitcoin banks get hacked. Bitcoin exchanges get hacked. By using them, you give up that core Bitcoin promise of control for convenience.
So what's the alternative?
The alternative is a non-custodial wallet. Here, you hold your private keys. You have sole, absolute control over your funds.
The your keys, your money ideal?
Precisely. Your keys, your money. It's the heart of decentralization, direct financial sovereignty. It means more personal responsibility, definitely. You lose your keys, you lose your money. But it puts you in charge.
Okay, so if I go non-custodial, hold my own keys. How do I store them safely? I hear people talk about hot versus cold storage. What's that about?
Yes, that hot versus cold distinction is absolutely critical for security when you're managing your own assets. Hot storage basically means any wallet that's connected to the internet, even sometimes.
Like my phone app or computer software?
Exactly. Mobile apps, desktop software, web wallets accessed through a browser. They're super convenient for everyday use, frequent transactions, because they're online and ready. But being online makes them more vulnerable.
To hackers.
To online attacks, yeah.
Yeah.
Malware, stealing keys from your device, phishing scams, tricking you into revealing your keys. The convenience comes with higher risk.
Okay, so what's cold storage then?
Cold storage means wallets kept entirely offline. This is the gold standard for security, especially for larger amounts or long-term holding. Because it's offline, it's essentially immune to online theft.
Makes sense. Cold storage is not online? Like what?
Good examples are hardware wallets. Those little physical devices often look like USB sticks. They generate and store your keys completely offline. Or even simpler, a paper wallet, which is literally your keys printed on paper.
Paper. Wow.
And for even more security, especially for significant amounts or for groups, you can use multi-signature or multi-sig wallets. Yeah, imagine needing, say, 2 out of 3 different private keys to authorize a transaction. So even if one key is lost or stolen, the funds are still safe. It eliminates single points of failure, great for large amounts of cold stored coins or business funds.
So hot is like my checking account, easy access but less secure. Cold is like my safe deposit box, safer but less convenient.
That's a perfect analogy. Exactly right.
Okay, so whether it's a hardware wallet, paper, or a super secure offline computer, what if I lose the device? Or my house burns down with the paper wallet inside? How do I get my funds back then? This is where seed phrases come in, right?
The seed phrase, yes, this is your lifeline, your ultimate backup. It's probably the single most important piece of information you'll have.
What is it exactly?
Most non-custodial wallets give you a seed phrase, sometimes called a recovery phrase or mnemonic phrase. It's usually a sequence of 12 or 24 simple English words.
Like apple, banana, carrot.
Exactly like that. This sequence of words acts as a human-readable master key. It can regenerate all your private keys and addresses associated with that wallet. So if you lose your hardware wallet, your computer dies, whatever, you can install the wallet software on a new device, enter your seed phrase, and regain access to all your funds.
Wow, okay, so that phrase is critical.
Absolutely critical. But there's a danger here related to something called brain wallets.
Brain wallets, memorizing the phrase.
Kind of. Early attempts involved people trying to create their own passphrase, maybe a line from a song, a quote, a few words they thought were clever, and then hashing that phrase to generate a private key.
Sounds insecure.
Very insecure. If the phrase isn't truly random and incredibly strong, like if someone used the word bones or a common quote attackers can use offline guessing or password cracking, they have lists of common phrases, song lyrics, dictionary words. They hash them all and check if any resulting key controls an address with money.
And they've actually stolen money this way.
Oh yes, lots of it. They don't reverse the hash, they just guess common inputs. So the strong advice is never create your own seed phrase. Always use the one randomly generated by your secure wallet software, usually derived from a random 80-bit number or more, and then you store that phrase incredibly safely, offline, never digitally.
That makes sense. Generate randomly, store safely.
That's the key. The security of everything hinges on the secrecy and randomness of that seed phrase.
Okay, this leads to another really practical question, a key knowledge gap for a lot of listeners, I think, people who aren't cybersecurity pros. Given all these risks, online wallets getting hacked, losing devices, messing up seed phrases, brain wallet dangers,
Yeah.
what can the average person actually do? What are the practical steps to keep keys safe from both theft and just plain losing them?
That's probably the most important question for anyone holding crypto. And yes, there are definitely practical, manageable steps.
Like what? Give us the rundown.
Okay. First, diversify, but start small. Don't put everything in one place, especially at first. Small amounts for playing around. A reputable mobile non-custodial wallet might be okay, but for serious amounts, long-term holds. Get a hardware wallet. It's the single best investment. They're built specifically to keep keys offline and safe.
Okay, hardware wallet for big amounts. Got it.
Second, treat your seed phrase like it's priceless, because it is. Write it down physically. Paper, maybe etched on metal. Store copies in multiple, secure, secret offline locations. Fireproof safe. Safety deposit box, maybe with a lawyer. Critically, never store it digitally. No photos, no computer files, no cloud storage. Don't share it with anyone, ever. And double check it was randomly generated by the wallet, not something you thought up.
Multiple physical copies, hidden well, no digital.
Right. Third, basic digital hygiene is crucial. Use strong, unique passwords everywhere, especially exchanges. Enable two-factor authentication, 2FA, preferably an authenticator app, not SMS, which is vulnerable to SIM swaps. Be hyper-aware of phishing. Never click weird links. Never ever type your seed phrase or private key into a website or give it to someone asking online. Your wallet only needs the seed phrase during initial setup or recovery, nowhere else.
Be paranoid online, basically.
A healthy paranoia, yes. Fourth, double-check every single address. Remember, transactions are irreversible. Before hitting send, check the recipient address, character by character. Copy-paste errors happen, and malware can swap addresses in your clipboard. Send a tiny test transaction first, for large amounts to a new address. Verify it arrives before sending the rest.
Test transactions, good tip.
Finally, understand the convenience versus security trade-off. Custodial exchanges are easy, but you lose control and add risk. Non-custodial wallets give you control, but demand responsibility. For your main stash, prioritize security and control. Seems like a lot at first, but these habits become second nature.
That's really practical, actionable advice. Thanks. Okay, so we've covered the building blocks, the transaction journey, keeping funds safe. But what else can crypto do beyond just sending money A to B? This brings us to something really interesting. Smart contracts.
Smart contracts. Yes, this is where blockchain tech gets really powerful, moving beyond just simple currency. They're essentially self-executing contracts.
Self-executing.
Yeah. The terms of the agreement, the rules, are written directly into code on the blockchain. This means the contract can enforce itself automatically with some degree of technical enforcement without needing traditional middlemen like lawyers or banks.
The code is the contract, and it runs itself.
Pretty much. The trust shifts from people or institutions to the transparent, verifiable code. A great analogy is a simple vending machine.
Okay.
You put money in, meet a condition, you make a selection, another condition, and if everything checks out, the machine automatically dispenses your soda, executes the outcome. No human needed to oversee that specific transaction. The machine just follows its programming.
I see. Input, rules, automatic output.
Exactly. Another really good analogy mentioned in our sources is digital escrow. Bitcoin's own scripting language, though basic, combined with miners and validation, can actually realize the escrow protocol entirely without a centralized authority.
So holding money until conditions are met, but done automatically by code.
Precisely. You get the function of a trusted third party, but without needing to trust or pay a third party. It's built into the network protocol, reduces risk and fees dramatically.
That sounds incredibly useful. Can you walk us through a concrete example, like that automatic escrow? How would that actually work?
Sure. Let's take a common online scenario. You want to buy something unique, maybe custom made from a seller online.
Yeah.
You don't fully trust them to ship after you pay, and they don't fully trust you'll pay after they ship. Classic standoff.
Happens all the time.
Right. Traditionally, you might use a third-party escrow service. Pay them, they hold the money, release it to the seller when you confirm receipt. But that adds fees, delays, and you have to trust the escrow company.
Okay, so how does the smart contract version work?
With a smart contract escrow, instead of paying the seller directly, you'd send your crypto to a special smart contract address on the blockchain. The contract's code, which is public so anyone can check it, specifies the release conditions.
Like what?
For example, the code might say, release funds to seller address X only if Oracle Y reports that tracking number Z shows delivered status to buyer address A, or R if 14 days pass and buyer address A has not initiated dispute function B.
So it waits for proof of delivery or a time limit?
Exactly. If the condition isn't met, item never ships, tracking doesn't update, buyer disputes the code might automatically return the funds to you, the buyer. The key is it eliminates the need for that trusted third party. The Bitcoins would be released once the buyer certified that the goods had arrived, or once an automated data feed confirmed it. It creates a trustless environment. You trust the code, not the counterparty.
Trust the code. That's fascinating. And this idea goes way beyond just escrow, doesn't it?
Well, absolutely. This concept of programmable trustless agreements has huge implications. Bitcoin scripting is relatively basic, but the idea expands massively. You hear about smart property, linking physical assets like houses or cars to blockchain tokens and contracts, or prediction markets, basically betting platforms where payouts for predicting future events are handled automatically by smart contracts based on verified outcomes.
And other blockchains are built specifically for this.
Yes. Platforms like Ethereum, which launched in mid-2015, were designed with explicit support for much more complex smart contracts. They use concepts like gas to measure and limit the amount of computation a contract can perform, preventing abuse.
But there have to be limits, right? Can code really handle everything?
That's a crucial caveat our sources raise. Even with this technical enforcement, the law is not an algorithm. It's tempting to think code can just replace legal systems, but law relies heavily on human interpretation and discretion. Code is rigid, deterministic. The real world is messy, ambiguous, full of unexpected events.
Which leads to a really important question, another potential knowledge gap, perhaps. How do these smart contracts actually deal with real-world curveballs? Ambiguities, disagreements, situations the code just didn't anticipate. Can code truly replace nuanced human judgment when things go wrong?
That's the million-dollar question, isn't it? And it points to a major area of ongoing work and debate. The short answer, no, code alone can't perfectly replace human judgment for every complex situation. Smart contracts are only as smart as their programming and the data they get.
What if the data's wrong?
Exactly. This is where oracles come in. Oracles are like bridges, feeding real-world data, stock prices, weather, delivery confirmations into the smart contract. The contract needs this external data to make decisions. But if the oracle provides bad data, accidentally or maliciously, the smart contract will execute based on that bad data, potentially irreversibly.
So the oracle becomes a point of trust again.
It does, yeah. It shifts the trust point. People are working on decentralized oracle networks to make them more reliable, but it's a challenge. And what about disputes? Things the code just doesn't cover.
Yeah, what then?
Solutions are still evolving. Some platforms are building in optional dispute resolution. Maybe human arbitrators are called in if there's a disagreement. They'd review the situation, make a judgment, and their decision could be fed back via an oracle to trigger the final payout.
So humans intervening in the code.
In a structured way, potentially. But the core challenge is real. Translating fuzzy human agreements and unpredictable reality into precise, logical code is hard. Smart contracts are great for clear, simple conditions. They struggle with subjectivity, unforeseen events, or even simple mistakes in how they were written. For complex stuff, they often still need to work alongside traditional legal frameworks or have very robust oracle and dispute systems. It's where tech and law are still figuring things out.
Yeah, it really highlights that human element is still key, even with amazing tech. Okay, as we start to wrap up this deep dive, we have to talk about the risks. New tech always has challenges, right? Cryptocurrency is no different. This isn't about scaring people, just being informed.
Absolutely. Eyes wide open.
One big one everyone talks about, price volatility.
Oh, yeah. The roller coaster. The buying power of crypto, like Bitcoin, is set by market forces, just like dollars or euros. But historically, Bitcoin has been highly volatile. One source called it a guppy swimming in shark-infested waters.
That's vivid.
It is. We've seen shifts of 20 or 30% in a day.
Hmm.
That makes it tough to use as stable money for everyday things because its value compared to goods can swing wildly.
But is it getting better?
The long-term trend suggests yes, volume is up, transactions are up, and generally volatility keeps dropping as the market gets bigger and matures.
Yeah.
And volatility is relative, right? Compared to the dollar, maybe it's high. Compared to some hyperinflating national currencies, maybe not so much.
Good point. What about the transactions themselves? Any risks there?
A huge one. They are effectively irreversible. Once your transaction is confirmed on the blockchain, gets those confirmations, it's now difficult to change. Extremely difficult.
No chargebacks like my credit card.
Nope. No central authority to appeal to. No undo button. This means you have to be incredibly careful. One mistake can create an unwanted, irreversible link, send coins to the wrong address, get tricked by a scammer. That money is likely gone. Forever.
Ouch. High stakes for typos.
Very high stakes, which leads directly to the next risk, scams and hacks,
Always a concern with money online.
especially here. Centralized exchanges, holding billions in user funds. They are large security honeypots, prime targets for sophisticated attackers. Many early ones were just centralized custodial exchanges using PHP in my school. Not exactly Fort Knox, if not built perfectly. We saw what happened with Bitfinex, losing 40% of the money.
So exchanges are risky. What about my own keys?
Also at risk, your private keys can be stolen through malware or in phishing attacks. Bad software on your computer, fake login pages trying to steal your info. Social engineering, too. Attackers tricking you into revealing secrets or sending them coins.
And privacy. Is Bitcoin anonymous?
Not really anonymous, more pseudonymous. You use addresses, not names. But clever transaction graph analysis can often link your different addresses together. If your real-world identity ever gets linked to a Bitcoin address, maybe through an exchange that knows who you are, then you have totally lost privacy for all transactions past, present, and future associated with that address.
Wow, totally lost.
Potentially, yes. Even your IP address could be used to link you to transactions if you're not careful, maybe using something like Tor to hide it. People use dedicated mixing services or techniques like CoinJoin to try and obscure the links between transactions, shuffling coins with others. But even then, anonymity is fragile. One mistake can create an unwanted, irreversible link. True anonymity is hard.
Okay, so technical risks, personal security risks. What about the bigger picture? Regulations.
Absolutely. The regulatory landscape is constantly shifting, complex and different everywhere. How do you regulate this new kind of digital asset and the businesses around it? It's a huge question for governments worldwide.
Are they cracking down? Or embracing it?
Bit of both, really. But a key idea is, if Bitcoin is big enough to matter, then it is big enough to get regulated. We see things like New York's BitLicense. It forces crypto businesses operating there to hold financial reserves, follow strict anti-money laundering, AML rules, have solid security plans, protect consumers.
So making them act more like banks.
Exactly. The source notes that Bitcoin businesses start to get closer to the traditional model of regulated financial institutions. This is kind of a step away from the original cypherpunk dream of total decentralization and no oversight.
But maybe necessary for mainstream adoption?
That's the argument. It's seen as an inevitable step as the ecosystem matures, tries to integrate with the existing economy, and governments try to manage risks and prevent crime. It's a constant balancing act between innovation and control.
Okay, that's a lot of risks to consider. Volatility, irreversibility, scams, hacks, privacy issues, changing regulations. With all that, what can someone actually do to navigate this safely? Can you give us that practical checklist again, maybe boiled down?
Definitely. A smart, careful approach is key. Here's that checklist, distilled.
Your keys, your money. Seriously, use non-custodial wallets for significant amounts. Use cold storage, hardware wallet for long-term holds. Understand hot versus cold. Control your keys.
Verify everything. Twice. Addresses especially. Transactions are final. Send a tiny test first for big amounts. No typos allowed.
Seed phrase is sacred. Use the randomly generated one. Store it physically securely, offline, multiple locations. Never digital. Never share it.
Extreme skepticism. Assume unsolicited offers, DMs promising riches, guaranteed returns are scams. Because they probably are. If it sounds too good to be true, it is. Don't trust, verify.
Do your own research. DYOR. Understand the basics like what we covered today. It helps you separate fact from fiction. Don't just follow hype.
Privacy is hard. Assume you're not anonymous. Use tools like Tor if you need network privacy. Understand mixers have risks and limits. One mistake can link you forever.
This whole deep dive, it really highlights something fundamental. Cryptocurrency, especially Bitcoin. It marks a massive shift in how we even think about money, how we interact with it.
How so?
It's a system designed from the ground up to be decentralized, secured by advanced math, by cryptography, and by really clever economic incentives. It offers individuals a level of direct control over their value that's pretty unprecedented. It's trying to build trust in math, not just institutions.
Yeah, we've definitely covered a lot today. From the basics, ledgers, keys, addresses, to watching a transaction go from idea to confirmed block through mining and confirmations. We looked at wallets, keeping things safe, the potential of smart contracts, and importantly, the risks and how to manage them.
Quite the journey.
It really was. And hopefully, the power of this knowledge, being able to engage with this new financial world safely, intelligently, is now more in your hands, the listener. So here's a final thought to chew on. Bitcoin is often called this gift to the entire world, arriving faster than you can imagine. Does it aim to completely replace traditional banks, governments, all the intermediaries? Or maybe, as one source suggested, is its biggest potential actually to complement the functions of the state, rather than seeking to replace them? What do you think the future holds? Complete disruption? Or some kind of new partnership between this tech and the systems we already have?
A big question indeed.
It is. And hey, we've only scratched the surface here. This world is huge and constantly changing. So what aspect of cryptocurrency or blockchain should we explain next? Send us your questions, your topics. We'll prep another deep dive just for you.